Welcome to This Explainer. Today, we are going to completely change the way you look at a company's financial health. Because let's be honest, if you've ever glanced at a balance sheet or an income statement and thought you had the full picture, well, think again. We're moving far beyond just surface-level numbers to decode the real truth hiding in the margins. I want to kick things off with a quick financial riddle, just a little thought experiment to test your instincts. Imagine you're tasked with evaluating two different businesses to figure out which one is fundamentally performing better. Sounds simple enough, right? Let's take a look at the raw data. So here's the scenario. Company A brings in a revenue of 10 lakh rupees with expenses of 8 lakh. Meanwhile, Company B is a leaner operation. They're bringing in 8 lakh in revenue with 6 lakh in expenses. At first glance, looking purely at the cash flowing in and out, which business would you rather own? Do the simple math on both, and boom, you get an identical absolute profit of 2 lakh rupees for each. Company A, 2 lakh. Company B, 2 lakh. On paper, it literally looks like a dead tie for wealth generation. They are identically successful at producing cash, right? Well, here is where so many people get tripped up. I like to call it the absolute profit illusion. If you strictly rely on the traditional income statement, you'd absolutely assume they're tied. We're conditioned to just scan for the bottom line, see that the profit matches, and stop asking questions. But stopping there means you completely miss the actual operational reality. Let's uncover the truth hidden in the percentages. By calculating the profit margin, just dividing that 2 lakh profit by the revenue, a completely new picture emerges. Company A is sitting at a 20% margin, but Company B, they are actually making a 25% profit margin. They're extracting that exact same 2 lakh, but on a much smaller capital footprint. Efficiency wins every single time. Let's zoom out and look at how this plays out chronologically. Imagine your company makes a 2 lakh profit in 2019 at a 20% margin. Then in 2020, you make the exact same 2 lakh profit. Lazy analysts might shout about zero growth and a stagnant business. But if that 2020 profit was achieved at a 25% margin because you slashed costs effectively, you've actually achieved highly favorable growth. Your business became intrinsically stronger despite a completely flat bottom line. And this brilliantly illustrates our core concept. True analysis of financial statements isn't just about finding the profit, it's about evaluating if that profit is actually favorable. It's about shifting your entire paradigm from passively reading a statement to actively interrogating it to see how the engine really runs. And you know, this analytical mindset, it forces us to ask really tough questions about the balance sheet too. We can't just verify that assets equal liabilities, we have to ruthlessly interrogate these line items. Do we have enough of the right kind of liquid assets to immediately cover our short-term debts? It is incredibly common for a cash-poor but asset-rich company to suddenly go bankrupt simply because their wealth is tied up in illiquid machinery or real estate. So, how do we actually figure all this out? To decode the real story, we need to deploy a specific analytical toolkit. We use formulas and ratios that act like a diagnostic magnifying glass, revealing those deeper operational realities that raw numbers naturally hide. Think of this toolkit like a comprehensive medical checkup for a corporate entity. We categorize these tools into 5 main ratio categories: liquidity, leverage, activity, investor, and profitability. Each category diagnoses a different vital organ of the business. And just like the human body, you absolutely need all 5 systems functioning smoothly to survive and thrive. Let's break these down, starting with your immediate survival metrics. Liquidity ratios look at your working capital to ensure you can actually pay your short-term bills. If suppliers demand payment tomorrow, will you survive? Then we have leverage ratios, which look at your long-term structural health by comparing your debt versus your equity. In a high-interest rate environment, being over-leveraged can quickly wipe out all your profits. Leverage tells us who really owns the risk. Next, we diagnose the operational engine using activity ratios. This tracks the daily pulse. If you have millions in inventory gathering dust in a warehouse, that is a massive drain on your liquidity. These metrics tell us how fast you turn raw stock into sales. Alongside these, we use profitability ratios. Like we saw with Company A and Company B, these measure the true efficiency of your wealth generation, using margins and returns on capital, instead of just the absolute bottom line. But we have to look at this from the outside too. It is absolutely crucial to recognize that external investors view these statements very, very differently than an internal factory manager does. A manager might obsess over the daily speed of inventory turnover, but someone looking to allocate external capital has a fundamentally different set of priorities. That external investor isn't losing sleep over your short-term liquidity, as long as you aren't going bankrupt. They look directly at our fourth category, investor ratios. They are calculating earnings per share, dividend yield, and the all-important price earnings, or PE, ratio. They use this to gauge if your stock is cheap or expensive relative to the profit engine we just diagnosed. They just want to know exactly what financial benefit they will get. So it all comes down to this. Looking at financials without these ratios is literally like judging a book by its cover. The absolute numbers are just the dust jacket. The next time you review a company's financials, will you fall for the illusion of the bottom line? Or will you do the math, apply these ratios, and uncover the actual truth?